Okay, everyone, we're going to go ahead and get started. Hopefully you can hear us. I believe everyone can at this point. We're going to jump in. This is a webinar, and so I can't see your smiling faces or hear you, but just a reminder to use the chat function for Q&A, and we'll try and respond to those throughout the presentation, as well as leave some time at the end. So today's webinar is an insider's look into 1P versus 3P. We really appreciate everyone who is attending. At Pattern, we enjoy what we do, and this is a topic that's near and dear to us, and you'll find out a few reasons why in a second here. But we'll start off by going through introductions, and then we'll jump into the slides themselves. So just to give a background of who we are and why Casey and I are actually presenting on this topic today. My name is Bryce Warning. I'm the Vice President of Global Business Development for Pattern. I handle all of the traditional inbound and outbound outreach, as well as some strategic categories and focus areas for the company. Prior to Pattern, I was with Amazon for 7 years, both in the US headquarters, Seattle offices, as well as in Australia. As way of background, I led supply chain for lawn and garden. I was around $1 billion in receipts at the time. Was the head of buying for home improvement, which also included major appliances and smart home. And then in Australia, I was pre-launch for the country launch there, and ended up leading as category leader for the electronics category. So 1P versus 3P, something that I've been around for quite some time. Casey, why don't you give an introduction quick?
Yeah, thanks for the intro, Bryce. It's fun doing this with Bryce here. Both of us working for Pattern now. I've been with Pattern the last 1.5 years. Prior to that, I spent 6 years at Amazon on the 1P retail side of the business. Went through both in-stock and vendor management functions, both as in-stock manager, vendor MVM, as well as leading an in-stock team on the pets team for 1.5 years, and then leading a vendor management team over automotive. And then Bryce and I had crossed paths early in my career at Amazon on home improvement for 9 months or so, as we were on that same larger team. I've got 15 years of retail experience. Prior to Amazon, it was brick and mortar retail experience, and then 6 years at Amazon on the e-commerce side. And then the last 1.5 years here with Pattern on the third-party side of the business. So I've kind of lived both, well, the brick and mortar, and then the 1P, now the 3P business.
Okay, let's go ahead and kick it off. So I would imagine most, if not all, of those attending this have some level of understanding of what 1P or first party means and what 3P means. But to give a baseline, I just want to quickly cover off on some basic definitions. So on the 1P side, that is an invitation only, and we're talking specifically about Amazon within this presentation. Obviously, there are other marketplaces where this applies as well. But on Amazon in the US, it's invitation only. Amazon must invite you to be a vendor. And the main difference between 1P and 3P is at that point, Amazon buys your stock and sells it. They control the pricing. They control that last mile experience to the customer. They own the product. And on the 3P side, whether you're doing the last mile delivery, you can still use Amazon, but the biggest difference is you still own the product, you control the pricing. That's the basic highest level definition and differentiator. But what I'd call your attention to is a few of the things below that on the selling, pricing, marketing, and operations. What you'll see is beyond who owns the product and who prices it, a lot of the other aspects are very similar, if not the same. And this is something that I think is overlooked a lot of times. We're going to dive deeper into what some of these differences are and what is similar. But just from a high level, the main difference is who owns the product, who prices it, and who delivers it. We're not going to tell you today. We get a lot of questions from brands that say, which one should I be? And the answer is always, it depends. And so today, I don't really want to know necessarily, I do want to know which one you're on currently, but the bigger question that I want everyone to think about is why. Oftentimes we talk with brands and they'll say, we're 1P, we've always been 1P. And when we ask why, they hesitate, they don't know how to answer it, they're not sure. or we've always been 1P. And the same thing on 3P. Brands have worked with a partner, they've done it themselves, whatever. But when we ask the question of why, they don't have a full understanding. And the hope with today's presentation is to either get you to that answer or to get you thinking about what is our strategy, and is it the same as it was 5 years ago? Should it be changing? Should we be looking into something different in the future? So in the chat, because we want to keep this a little bit dynamic, if you could put brand name and what model you're on currently, that would be really helpful. That's going to give us an idea of kind of where are we leaning with the attendees right now, 1P versus 3P. And we'll use that as we go through this. And someone said chat is disabled. I'll have Rebecca look into that.
Rebecca's putting it in the Q&A.
Q&A, sorry. Okay. Okay, so I just talked about the major differences, 1P versus 3P. But the underlying definition, you know, we've got this basic who owns it and who prices it. But the reality is it's a spectrum. And it's not, should your products be all on 1P, all on 3P? More likely the answer is it's going to be across the board, and it might depend on the type of products. Maybe some of your SKUs, some of your lines are 3P, some are 1P, as well as the marketplace. We're going to talk a lot about the US, but depending on which region you're in, that might determine what model you should go with as well. So let's just talk through kind of what we see as far as the different seller strategies across the board. I'll start to the far left, which is 3P unmanaged. At this point, Amazon has kind of developed to where most brands are there, but there are brands that are on Amazon, but it's not them. And they don't want to be there. And so they just kind of, we show in the benefits here, ignorance is bliss. It's kind of that we know our stuff is there, but we don't want to deal with it, and we're just going to let it go. And we call this kind of Wild West seller strategy. Now, obviously, ignorance is bliss. You don't have to worry about it. Drawbacks, your brand is there. And so if you're not controlling it, it could be a negative experience for the customers that are buying it. Obviously, pricing, inventory levels, the content that's there, you aren't controlling that. And many customers, even though you might think they immediately look to see who's selling it and where is it coming from, many customers don't actually understand that. And so when they see your product on Amazon, there is an assumption that it's coming from you. And you don't want to have a bad experience. And so largely, I would say, while ignorance is bliss, that is not a good long-term strategy for how to use Amazon or any marketplace. But we do still see it. Then we get in. Go ahead, Casey.
Sorry, maybe just really quick. It's interesting that I chatted with a brand relatively recently that was doing tens of millions of dollars on Amazon, selling via 3P unmanaged. They were a brand that definitely did not want to be selling on Amazon, and their strategy was to not be there. And that's just interesting, you know, as you mentioned this one, that and they were selling tens and tens of millions of dollars of their products, or someone was selling it. It wasn't them. But as we looked at their products online, man, it was really poor listings, poor reviews, poor ratings, and it was kind of a poor experience for the customer who expected to be getting that brand's product. So to your point, drawbacks are real there. Whether you want to be there or not, it's something to at least manage and make sure if you don't want to be there, that the product's not selling there. If you are there, then you probably want to have some control.
Yeah, perfect. And it's exciting to see actually in the Q&A, I'm looking in the dismissed column, but we do have brands all across the spectrum here. So some that are 1P, a lot that are saying 1P and 3P, a few that have said they're transitioning from 1P to 3P currently, or using a hybrid model. So we've got everything, which is great because that'll help the conversation. So 1P, and I'll go through these relatively quickly so we can move on to other, what I would say are more important topics to dive into. But 1P, that's what we talked about. You're direct with Amazon. You do have more control. So you are the registered brand. You have a score that allows you to be the owner of the content if you have it. Amazon's placing the PO with you, so it's not a one-by-one sale. You're shipping pallets into their, hopefully pallets into their warehouses. Drawbacks there, and depending on usually the industry and the retailer, brick and mortar retailers you work with, this can be a really big pain point. No pricing control, so that fluctuation of price, inventory control, not knowing exactly when the POs are going to come through and how big they're going to be. And then one thing that we'll talk about at the end of this webinar is the fees. Not just the obvious ones of I'm in category X and the fee is 10% or whatever it is. But what are some of those maybe hidden or extra fees that get into the P&L that aren't as obvious and sometimes we don't keep track of? 2P, I'm going to brush over this one because we don't see it as much anymore, but this would just be, I give it to a distributor, they represent me on Amazon. We don't see that as much. Usually if it is a 2P, they're going through a distributor, it's a hybrid model of some sort. And so then we'll get to the 3P side. If we go full 3P, you own it. That is, you own all the inventory, you own the content, you own the pricing. We have benefits there as potentially higher margin, control on your inventory and listings. But the drawbacks, and this is one that we see a lot, is capability wise. Most likely you're going to have to partner with someone, whether that be for how do I manage my ad spend, or imagery, content, chargeback, whatever. You're probably going to partner with someone. And so with a lot of even big brands we see, it's who runs your e-commerce, and it's one guy in the back room doing his best. So we have seen some brands be very successful selling themselves on the 3P side. Generally, that's with a very large team, and it's developed, and they've been doing it for a while. It's very difficult to manage it entirely yourself with limited resources. And so that's where we do see, I'll go all the way to the right, 3P partner, and some form of that, where either a partner like Pattern that's going to do basically everything for you, or some in between where maybe you're doing pieces of it, your partner's doing another piece. Maybe you have multiple partners that are owning different pieces of the puzzle for selling on Amazon. But that's the one when we talk about 3P that we see more often than just a brand owning the entire function themselves. And then the in-between there, and this is one to call out, and I know we saw some brands are already using a hybrid model. This is hybrid where some is 1P, some is 3P. And I think this is smart. We're seeing more and more brands think about things this way. Because generally it means you're thinking about it. You're thinking about, for these types of products, whatever, I need to keep price because it's a new product. And so we just want to go out with a consistent price and we want to maintain that. And then maybe we'll move it over to 1P later. These are high velocity products and they've been going for a long time. I'm going to move those into 1P. But hybrid is a model that we're seeing more and more where brands are differentiating based on specific needs, what they put into 1P, what they put into 3P. And that could still be using Amazon to do the fulfillment, but just those aspects of control on each side are where we're seeing brands start to leverage the hybrid piece. So again, as we go through the presentation, we bring this up because we want you to think about it. It's not a one size fits all. We're not going to tell you everyone should be 3P or everyone should be 1P, but most likely what you're doing right now, in the long term, it's going to change. You're going to bring in new products. There's going to be fluctuations in something in your industry, and it's going to change. I'll bring up one specific, and actually I see someone that's in premium beauty on the chat. I'll bring up that as an example. We actually have a brand that said, hey, we just want to be in premium beauty because of the gating. So if you're not familiar with premium beauty, there's programs like this in certain categories where you pay the fee to sell in the category. Premium beauty, you pay an additional fee. In this case, it's 15% additional fee. And there are some things that go along with it for customization and how your products look and feel on the site. But mainly you're paying for gating. So the easy button to say there are no sellers allowed to sell against this brand and these products. For some brands, that makes sense. Just, hey, our distribution channel is all over the place. We don't know who's selling our product, and it's very hard for us to get control of that. We'd rather just pay for the gating and be done with it. For other brands, we would tell them, you can do this yourself, but it takes work. You're going to have to clean up your channel. You're going to have to understand who has your product, where did they get it, how much are they selling it for, you know, and really start to put controls and limits on who can be there and why. So I think that's a good example of a program that, depending on where your brand is at, it may or may not make sense. Again, it's not a one size fits all strategy. It's dependent on the brand and the products.
Hey, Bryce, well, we've got a quick pause. We've got a question in the chat that comes up pretty frequently and want to get your quick thoughts on it, and I can share mine as well. But the question is, does Amazon treat 1P products better than 3P, such as boosted rankings, etc.?
Yeah, that's a great question. So I would say at a high level, you know, years ago, and we're going to talk about this more further down, but like you could only participate in Prime Day if you were a 1P vendor. Those types of things are gone. You have just as much access, in some cases more access, to programs, promotional events, opportunities as a seller as you would as a 1P vendor. As far as Amazon's algorithm and how they do that, Casey, you were there more recently. Maybe you want to talk to that.
So Amazon's going to rate different products differently with their A9 or A10 algorithm. I don't know all the parts of that, all the components, but conversion is a high portion of that. So if your products convert, Amazon's going to want that to be reflected the best. So whatever product's converting and staying there is going to be the best way. If the seller rating that you have, whoever's selling your product, if they have a poor seller rating, that tends to drop conversion. So that's going to not bring things up the search results or anything. Otherwise, it's pretty agnostic of which selling channel. Amazon just wants to be able to raise up and help the products sell or be shown to the eyeballs of people looking of whatever they think they're going to convert on the highest, because that's what Amazon wants, is them to convert and click the buy price there.
Yeah, good answer. And I think one thing that we can't answer is, what is that algorithm completely? I know we hear rumors of Amazon's private brands always show up at the top, things like that. Really, even Amazon employees don't know how all of those algorithms work. But what I would say is you do have access to all of the different promotional events and opportunities as a 1P vendor. I saw in the open questions as well, and this is one that we've seen a little bit more recently as well, is I'm in a hybrid model. I'm 1P for certain products, I'm 3P for others. It's not letting me add new products on the 3P side. This has come up. So it's difficult, I guess. For Pattern, we don't have to deal with this because we're a 3P, not a brand seller. And so brands working with us, even if they have a 1P side to their business, we kind of get around the rules or the crackdown, I guess, if you will, because we are not the actual brand. But we have heard this coming from brands where the vendor managers are kind of trying to force it to all be 1P. Casey, any thoughts on that from what you've seen?
Yeah, I've got a slide later on where I'll go into a little bit more detail on this. The question was a common one. It's where Amazon, I believe, is applying NOR, or new offer restrictions. What they want is for brands to meet certain requirements if they're moving from 1P to 3P. And it's CX requirements, right? They just want the best customer experience. And if they find that that's not happening on the third party, whatever the seller platform is, then they can apply this new offer restriction where it says we're not going to let you upload any new offers to the 3P side. So we'll get into a little bit more detail here shortly on that.
Okay. We'll move forward. So I won't go too in depth on the international aspect of it, but only show this slide to say, if you are a global brand looking to go outside of the US, and even in the US for certain marketplaces, you will be forced, depending on the marketplace, to have a 3P strategy. Alibaba, and so I have Tmall, JD in China, that is by far the largest marketplace opportunity in the world. I think it's about 3x the US. It is only 3P. And so whether you're doing it yourself or selling through a partner, the only way to take advantage of that opportunity is to be on the 3P side. But then you have others like Coupang in South Korea where it's 1P only. And so depending on where you go, the type of brand you are, where you want to be as far as global expansion goes, your strategy may have to change. And especially, going into places like China, where it is a very, very different model and buying patterns from customers there. In most cases, a partner makes sense, unless you have some deep understanding of that region and of that marketplace.
And Bryce, several brands that I talked to have come up through the brick and mortar retail side, which is essentially if you're selling into a brick and mortar retailer, you're virtually doing a 1P model. So a lot of brands, that's kind of how they started. That's how they thought about retail. And that's kind of why we're sharing some of these things is, hey, as you get into e-commerce and other channels, other marketplaces, sometimes all the same options are not available, right? 3P, 1P, 2P, hybrid are all things to consider across any marketplace that you're in.
Okay, so let's dive into kind of Casey and I, what we've seen behind the curtains. This is not, secrets, but this is more just kind of our perspective on some changes that have happened over the years. So Amazon, if we look way back, Bezos' vision was to be, and always has been, the most customer-centric company in the world. And so if you think of it from that lens, the actions or the rules or whatever that they put in place is entirely based on how do we make the customer experience as good as possible. Now, early on, and even some things today, a lot of that was control. If Amazon can control the last mile, the way that it's delivered to the customer, guaranteeing, 2-day delivery or just guaranteeing a day for the delivery, pricing comparison across different retailers, that was all built out to drive a positive customer experience. And like it or not, Amazon has revolutionized the way we shop. Years ago, you would have never thought of 2-day shipping. And now when we get online and go to a site and it says 7 days, we're almost appalled. And so these actions have driven it to be an easier, a better, if you will, customer experience. Now, there are, I'm sure, things where brands will say, yeah, but I hate this, I hate this, yes, we get it. But it was done for from a customer experience lens. Now, in recent years, Bezos has stepped down. He's sending rockets into space now. Jeff Wilke, he was CEO for Worldwide Consumer for a long time. Actually, while I was there, I interacted with him quite a bit. He had a very different view than some of the current management does as far as how things are run, because he was there early on. He was kind of coming up with that mentality that Bezos had. Blackburn, he came back, went again. Dave Clark, he's now running a logistics company. And so all of these kind of lifers that were at Amazon for all these years have moved on to other things. And where we're at now is Andy Jassy coming over as CEO. And then you have Doug Harrington running consumer. Now, Doug was in the retail org for quite some time. He worked with Wilke directly for a number of years. And so I would say he still carries a very similar mindset from before. Jassy's coming from AWS. And so I'm sure he agrees with a lot of what was done, but he's just looking at it in a very different way. It's not that it's right or wrong, it's just different. His approach is different. And so what we're starting to see is an even bigger push into the 3P side. Now, years ago, if you would have said, yeah, but it's all Chinese sellers, I probably would have nodded my head and agreed, because a lot of it was. But in recent years, we are seeing a lot of big established brands either moving entirely to 3P or running a hybrid model. That's for many reasons. And I'm not going to, again, it depends on your strategy as to whether that makes sense. But it is happening. And you're seeing, we've updated these slides to get into Q1 of 23. We're even seeing a bump now into 22 and 23, kind of that post-COVID coming out of it. What do things look like? We're seeing even more brands start to go in that direction. So we've seen in like Amazon, they have a show or an event called Accelerate. They've talked about it. Doug has talked about it and saying that 3P is a big push for them, and that they respect and really value those 3P sellers, whether they be a direct brand or a third-party seller selling multiple brands. So we don't anticipate this changing anytime soon. If anything, we're seeing more and more transition over. And what we're showing here is actually the unit side, but on the revenue side, it's even more of a higher percentage going toward the 3P side. So we show that to you just to give you an idea of, how big is this? And, we hear this 3P thing, but is it real? It is very much real, and it is a very large part of the retail business.
Now, Bryce, we do have a question on whether this is broken down at the category level with 3P toys, 1P versus 3P over time, etc.
So Casey runs RevOps, and so he can answer that.
See, if you want to reach out separately, we have some insights on this. This report here is from Statista. It's their annual report they publish each year, so you can see this. It's publicly shared, but we have our own data scrapes that we can share some insights if you want to look at certain category levels themselves. Bryce, I think what's kind of interesting about this is when I started at Amazon in 2016, it felt like, Amazon firmly believed that the best customer experience was often coming from the 1P side because Amazon controlled a little bit more of that. And I think there's still a lot of that belief from Amazon. What's interesting with that, though, is this trend has been pretty consistent with growing more towards the third-party network. And that was like surprising to me while working at Amazon, that Amazon would allow this to happen. Because Amazon, I believe, at any time could probably curtail this by raising the third-party rates or accepting more into the 1P side. And they've allowed this to happen and continue to allow that to happen. So it's something where a lot of brands may think, hey, the only way to do this is on 1P, or maybe the only way is on 3P, but there's definitely this trend that's happening, and it's not steady and flat, like a 50-50 split between the two.
That's great. And we've got another question, which I think leads into the next slide that Casey's going to take, but can 1P still, and I love the wording here, can 1P still punish vendors that migrate to a 3P or hybrid model, assuming ASINs are different 1P to 3P? So Casey, why don't we go into, do you want to just talk to this quick and go back to the pain points?
Yeah, let's talk to this for sure. Good question. And feel free to add any other questions, or if people have experiences or examples they want to share with the group, feel free to put those in the Q&A section there. I'll give you a couple of perspectives. Bryce and I can share our perspective from our time at Amazon and then our time here with Pattern, as we have seen this on both sides of things. What Amazon has created is a team called the Amazon Standards for Brands team. They use this team to help make sure that however the products are being sold, they are meeting Amazon's customer experience needs or requirements. As you think about the customer experience, you look at their 3 key pillars and priorities, which is convenience, selection, and value. So they want to make sure that whether the product's being sold on third-party side or first-party, that they can still get the product just as fast as they were getting it on the 3P side as they did on the 1P side, that they're getting all the same selection or just as much selection, if not more, by switching over. And then when you talk about value, really they mean price. And it feels like this is probably the largest reason that brands maybe would get their hand slapped from Amazon on moving over, is now the brands on the third-party side will control their own price. Amazon's very good at being algorithmic and price following. Because of that price following, they're able to stay very competitive. So I think the biggest place where I've seen brands struggle with this is they try to move to 3P, is they will not be competitive with the market. So if you want to move 3P, you have to think about that strategy, and one, saying, okay, can I be competitive by adjusting prices myself? Or two, do I want to hold price at a different price point where Amazon's at? If so, I need to make sure that my channels are clean, that no one else is selling, these rogue sellers aren't out there dropping the price, even not just on Amazon, but across other marketplaces that Amazon will, track and scrape. So Amazon does apply these different strategies that a few people have mentioned on here, where they will say, if you're not meeting these core pillars for them, the CX, then the Amazon Standards for Brands team, if you're 1P, will often reach out to the vendor manager and say, vendor manager, go speak with this brand and let's see what's happening and see if we can make sure the right CX is met. If it can't be resolved through that, then they will track and see what the products you're selling are. And then if you're not good on any of these three pillars, then they can potentially reserve that right to be able to make sure you can't upload new products. That's usually the way that the Amazon Standards for Brands team is, in the words here, you're saying punishing. That's how they would quote unquote punish brands, is by saying you're not meeting the CX, so we're not going to let you upload anything new. If it's sustained and prolonged, they could shut down the third-party account. I don't think that's their intent for the most part. But what I was doing as a vendor manager, I've had several brands ask me when I saw brands leave, which by the way, I did, and they left to work with Pattern frequently. That was my introduction into Pattern, was a couple of my big brands in my P&L had stopped working on the 1P side. I didn't punish any brand, and quite honestly, I didn't know how to punish any brand by moving to the 3P side. But for Amazon, Amazon wants to sell products, you know, hitting these three pillars, whether it's 1P or 3P. And that selection piece is a huge part. And if they start ticking off brands and making brands not allowing them to upload new products, and it doesn't end up being uploaded for the 1P side, then they're losing selection as well. So I think Amazon, in my perspective, wants to have a good harmony of making this work, but you've got to do it by meeting the requirements that Amazon has set forth. And that's why someone like Pattern actually meets with Amazon on a pretty regular basis to review these metrics and to make sure that all metrics are met. Bryce, what else have you seen? Anything else I left out?
No, I think that was good. I was just going to follow it up by saying, I think that, you know, the punish piece, it does come back to Amazon is trying to do this with the customer in mind. Now, you could also say it benefits Amazon in some ways, and I get that, but that customer-centric piece really becomes a pain point for vendors when they're, you know, saying, well, this is why I'm doing that. But I think that all kind of encompasses what we want to talk about the slide before, which is some of the pain points and some of this, you know, quote unquote punishment that some brands are seeing. So Casey, why don't you talk about that? I will bring up, there's a question in the Q&A. Within the last year, have you seen Amazon 1P no longer follow the market on retail, and instead let their inventory status, specifically overstock, undercut the market to help move excess inventory?
Yeah, I can talk to that briefly. So Amazon has what they call or consider OIH, stands for Optimal Inventory Health. Essentially, it means overstock inventory. They've had this program for as long as I know, where they're measuring and seeing products that are overstock. An overstock metric can be different by ASIN, by category, depending on how frequently it's sold or how cyclical it might be. But once it reaches some overstock threshold, what they tend to do is then mark it down. They're going to drop the price. And that's where you often will see it dropping below market points out there. And they're going to drop it and see if they can sell to get back to an optimal inventory amount. If they can't get there at that price, they might drop more. And if you look at something like Keepa and you see your prices in a stair step down, that often is when you're seeing this OIH funding, or they're marking it down to drive to move through inventory. And then you'll see it get back up. I think we've seen that or heard that from a lot of brands on the 1P side since after Bryce and I had left Amazon, particularly in the last year, as we kind of came out of COVID. There was this big dearth with supply chain. Then all of a sudden, everyone got really heavy on inventory. Amazon FCs got really filled up. And last Q4 in particular, as they're trying to get FC space, it seems like they lowered that threshold and started marking things down earlier to move through inventory. Definitely.
Yeah, that's what I was going to say. Is I don't think this is a result of a change in how Amazon is doing things. I think it's a result of the market. Post-COVID, this is on Amazon and off Amazon. There were logistics issues and production issues, and then all of a sudden there was a flood of products coming in, and a lot of brands were thinking, hey, this COVID train is going to keep going and keep selling, and they overstocked inventory. And so Amazon obviously has to get out of that position to, especially for Q4, free up space. So I don't think this is like a trend that is going to change the way that Amazon does things. I think it is just part of the OIH program, but it feels more severe right now because of the position that they're in, which you might be experiencing at other retailers as well. So Yeah, let's dive into these. And Casey, I'm going to let you take over on these pain points, but for the Q&A, or I'm saying chat, but the Q&A, if you want to throw in there, like, what are your top 2 or 3 while Casey's talking, it'd be interesting to see kind of what are those main pain points that brands are feeling. Now, this will talk a little bit specific to 1P, but if you're 3P, tell us what those pain points are as well.
Thanks, Bryce. And I think a lot of these will tie into 3P as well. From our earlier question we had, it was pretty evenly split between 1P, 3P, and hybrid. I think most everyone's going to feel several of these pain points. When we talk with almost any brand, we usually show these as some of the key pain points that Bryce and I saw as we worked with vendors and brands both on 1P and 3P. So some of them might be more specific to one or the other, but if everyone could try to put in just like, you don't even need to put your name, but just the top 2 pain points you're seeing out of this list, or if it's something different, we'd love just to see kind of what the group's seeing, and we'll dive in. While you're doing that, I'll kind of walk through some of these pieces and give a few insights and maybe a few thoughts on ways to try to resolve some of this as well. The first one up here is limited vendor manager support. Now, this could be if you're using an agency or anyone else, like what kind of time are you getting and resources and support are you getting from them? I think the SaaS program was interesting as that was rolled out with Amazon, or the SVP before that. It's a really cool program that I think offers a lot of support and help. However, as a vendor manager, my experience was the vendor managers loved this program because now brands are paying for additional support, that the vendor manager now can step back a little bit and do other projects and other things, and maybe take away some of their support with the vendors. My experience from my early days in brick and mortar retail versus Amazon, where I had maybe a dozen brands that I managed in brick and mortar. And then when I went to Amazon, there's thousands and thousands of brands that were in my P&L. And I just thought, how do you manage all these different brands? And you can't. So that's why Amazon has the ticketing system. That's why there's the SaaS program. That's why there's other programs that they've set up to try to allow brands to self-serve. But some brands get really, fed up with not getting that support they want. The second one on here is kind of interesting for brands as they look at how Amazon treats their product. Is Amazon vendor managers, almost every one of them are set up that they are managing categories. So they're not managing just brands, they're managing categories. Because of that, they really need their categories to grow and to meet their metrics, not necessarily specific brands. Now, certain brands might help drive that and mix in there, but really they're category focused and more brand instead of brand focused. Pricing is on there. This one's pretty obvious. Bryce brought this up early on, that prices, you control your pricing on the third party side. You don't on the first party side, and that can be good or bad. Some brands are like, great, I want to just set it and let the market dictate it. Others say, I have MAP, or I want to help pricing be relatively stable across all my different marketplaces as well as brick and mortar channels. And that can be a real pain for brands. The global piece is always challenging. Amazon usually work with vendor managers by marketplace, not necessarily like one person that's going to help expand, but they do have some programs for global vendor managers that can help with that. And I'll talk operations for a second and pause. But the operations piece is interesting. The number one thing I heard from brands on this from an Amazon standpoint was often that they had cyclical ordering patterns and they couldn't predict what true orders are going to look like. Having been on the in-stock side, I saw that. It's very algorithmic, and there's a lot of smart algorithm there, but a lot of up and downs based on times of the year, how much inventory they have, or tweaks or dials to the back end system of that. So you have to be thoughtful in saying, okay, if I sell in on 3P, you now own how much you're selling in, but you also now have to pay for the storage fees on that. And sometimes you have to buy more or buy less. So there's pluses and minuses there. Bryce, any themes that you're seeing in the chat?
Yeah, I've been trying to keep track of them all. I think cost increases and no VM support has come up a few times. I'm seeing chargebacks, profitability, something around that. One person just put pain points in general, so maybe all. But it does seem like operations, cost increases, and the VM support are the big ones here.
Okay, great. Well, let me touch on the chargebacks and shortage claims. This was the number one complaint that I heard when I was at Amazon. The number one complaint. Amazon continues to add chargebacks, which makes sense from like a supply chain and operational standpoint, as they need it as normalized as possible, coming from millions and millions of different sellers. So the way to do that is to put in chargebacks. But the challenge with that is, like, if a box comes in with a wrinkle on the label, you can get a chargeback. If you route 2 minutes late, it's a chargeback. If it ships in late, chargeback. There's all sorts of ways you can get chargebacks, and most brands will see that and then have to dispute those chargebacks as well, to try to see if they can reduce those or prove those out. It's a big pain point and takes a lot of time. I've heard a lot of brands say that they actually want to shut down their account for that. The way to shore those up is really to improve your operations, mostly to interact with Amazon and understand why you're getting the chargebacks. Or there's actually other options of working with third-party sellers who maybe buy the product from you, and then they're the ones ingesting the product into Amazon, because now they're the ones that would assume the risk of the chargebacks and shortage claims and not you. For shortage claims, there are, almost every brand sees this. There are, I know, different programs, different companies that will help you go back and actually try to claw back some of those the funds from shortage claims. But they tend to be an onerous process. It's takes a lot of time, but if you push on that, then you tend to be able to find some medium ground with Amazon on getting more back than they initially would offer, but you have to be willing to let that sit and bake for a while. Cool. The last couple pieces on here really quick: ticket loads, daily workload, that's hard. Even internally at Amazon, we often have to work through the ticketing system. Cost increases are a big one, but Amazon on the 1P side is willing to let that happen if the market prices rise, or if you can get other offsets through negotiations. Because really what they're trying to do is maintain their net PPM or their profitability. If you're on the third-party side and you control your pricing and you can just raise that pricing and it offsets it, and it could be a little bit quicker, easier there. And the last piece on this is AVN, which is a challenge. It's something, honestly, that most vendor managers don't love doing, and it's something that brands don't love being a part of as well. But I think the net result on that is that Amazon's trying to maintain or improve their profitability each year. And so they build out this accrual system where they have all these different accruals, and the way that they need to measure this up or right size it is to go back through AVN and kind of right size or see if they can improve profitability. It's a challenge, but it's something Amazon's leaned into for several years. Now it's a way that they can shore things up, and they make quite a bit of money coming back on that and negotiating and right sizing things. So I don't know that I see that going away, but it's definitely a challenge on the 1P side. Bryce, any other thoughts on those that you've seen?
No, I think that was good. They are painful, and we recognize that. I did want to touch on, there was related but unrelated one question on counterfeits. And this was a hybrid brand in the supplements category. I'll just quickly, because I know we're going to get to some other topics. Supplements is one of our largest categories. I believe we're the top supplement seller on Amazon US. There is no easy answer to this. Unfortunately, it's not a silver bullet of just do X and you'll solve all your problems. But what I would say on that is, first and foremost, brand registry. That's going to help you take more control of your brand. Amazon is pushing more programs in this space. So transparency, that's one where you can sticker your products where there's an identification so that they know if it's a legitimate product. And then I believe it's called the Counterfeit Crimes Unit, which is kind of funny, but that's relatively new within the last year, I think, which is a team within Amazon specifically dedicated to counterfeits. And they work very, very closely in the supplements space, because obviously if you're ingesting something that's a counterfeit, that can be very dangerous. So those are the things we've seen help. Another one that's kind of outside of Amazon's control and more on the brand is really regulating your distribution. Because if you can show Amazon who you sell to and prove it, it's going to be easier for them to track down the bad apples of who are these unauthorized sellers. as well as having some positions in place where you can also go after unauthorized sellers. But this is something we see it a lot internationally. South America in particular with Mercado Libre, counterfeits is rampant in the supplement space, but we are starting to see it more and more in the Amazon US space as well. So again, no quick and easy answer on that, but we are aware of it. And as Casey mentioned before, we have weekly calls with Amazon, and this is one of the topics that we talk about with the brands that we represent. Should we move on,
Yep.
Casey?
Yeah, just one other request to deep dive for a second on the shortage claims. From our experience, what we've seen, the number one reason that you get shortage claims is that Amazon is really, they're taking any PO you have, they're bringing it into the fulfillment centers, and then they're scanning in the POs. Now, what they're going to do is try to rectify that at the end and say, how many units did we scan in versus how many units did we expect to come in? And I think back in the day, they used to just pay the brands in full and then come back and ask for money and try to fight for that back if they didn't receive it. They swung the pendulum the opposite direction to say, we're only going to pay you for what we received. Now, what I understand is that more than half of the time, the shortage claims that you get are often not real. Now, what could happen is if the product falls off a conveyor and it doesn't get scanned in, or if it goes to their trouble line, maybe it has a wrinkle in the label or something like that, and it takes time to get it in, eventually it'll get in there and you just have to stay on top of that to try to go back and get paid back for that. So I think for the most part, they end up getting in there, but the simplest thing is it's only what they scan in. So the better you can build in your operations to make sure it's clean, there's no pains on it coming through the FCs on the conveyors or someone manually scanning it to make sure that there's no troubles or issues. That's the biggest root cause issue, I think, for what I've seen on shortage claims happening, but not being real. All right.
Let's get into the real exciting stuff.
Let's go into the numbers here. Okay. One thing I found when I came over to Pattern was that many brands don't understand how to look at Amazon 1P or 3P from a cost perspective. Brands might say like, hey, I know what my net PPM is on the 1P side, or I know what my wholesale cost is, but how do I like translate that and look apples to apples? So I've tried to be able to show a P&L here that will go through a quick example of how to try to look at that from both perspectives. Because if nothing else, you might be on 1P today and 3P might be cheaper for you. Maybe it's not, but it's good for you to at least analyze that and say, what is the right thing for me from a profitability standpoint? So as we look at the Amazon P&L, the way to look at this apples to apples from a 1P and a 3P side is to hit these 5 buckets on the 1P side. I'll go through them really quick. The PPM is the wholesale price. From an Amazon standpoint, all it is revenue minus cost of goods sold divided by revenue. So what they sell it for minus what they paid for it divided by what they sold it for. If you add the net PPM, all you're doing is adding your accruals on that. So that's your MDF, your damage allowance, your freight allowance, your SaaS contract would fit into this. If you have other marketing allowances that you're running other events with, promotions could fit in here. If you're paying for pallet or truckload ordering and there's an accrual there, all that fits into the net PPM bucket. And that's mostly where you're going to sit and talk with your vendor managers, is at that level. Now, if you look at the P&L, you drop below there, and there are other operating cost components of this, like the chargebacks and shortage claims. Like those things are actual costs that'll hit the P&L, but they won't hit the net PPM line. Or if you're looking at the charges for not being SIOC compliant, will roll up under there, or some other operational costs that will hit below the line, even like the advertising dollars that get spent. There's some portion that will go into that operating margin. But if you're looking at your total cost, you then need to drop below that and say, what are my off Amazon P&L costs to drive this marketplace? Usually what you're going to see is most brands are paying some sort of agency for the work to help support them. You have operational fees yourself to say, I need to break pallets down, I need to build them up. Or if there's variability in your orders, am I staffing people to do overtime or not. A lot of brands are paying for MAP or legal compliance. We use a brand or a company called Voorhees that we partner with, and we pay for that for our brand partners. Most companies are grabbing some sort of data provider, whether it's like Stackline, Helium 10, or other things that provide rich data sources to help them make these decisions. And then you also have like, am I staffing out a team to really drive this? And then there's the miscellaneous costs that I throw on there. Some of this comes from AVN, of knowing that your costs or prices are likely going to change. Your profitability mix is going to change from year to year. And Amazon said, hey, AVN works well during a 4-month period of time. Why don't we create a program called Always On Negotiation, which allows us to say, hey, if they're running promotions, how to make sure they get funded for that. You've got crap, other things like that that are going to adjust it. So this is a pretty decent, I think, holistic overview of saying, if I look at my 1P costs and I consider all those costs, what does that look like? Now I've got an Excel version that I'm happy to share with any of you who reach out and want to review this. On the left-hand side, I've tried to build out that same P&L that we just talked to on the previous slide. That's at a 1P side. I gave some suggestions that I've worked through with a brand on saying, okay, we know what our PPM is. What are some of the accrual costs that that brand's paying for? And maybe what percentage of their selling price that is. That gets to the total net PPM. You can even start this at the net PPM line if you just want to pull that out of, Vendor Central. And then you start looking down at things like chargebacks, shortage claims, SIOC, other advertising costs. What is all that adds up to a vendor margin? And then you go below there with additional expenses. It's a way that it might be not quite as intuitive, but it says, what cost am I spending on Amazon? Then on the right side, broke out more of a third-party cost. And as you look at the 3P side, if you haven't ever worked on the third-party side, the main things that you're going to pay is you're going to pay an Amazon commission fee. For most categories, it's usually category specific. Most categories, it's about 15%. Electronics is going to vary quite wildly. Some of the other categories, lawn and garden, I think is 12%. You're going to have differences, but you can actually see this in Seller Central on Amazon. Anyone can Google this and you can go see what is my product listed under and what are my fees for that. The other thing that you're going to pay is if you want this to be Prime and you don't have a Prime FBM offer where you can ship it yourself. Most all brands that are selling 3P and Prime are selling it through Amazon's FBA network. So if you do that, you're going to have an FBA pick, pack, and ship charge. That is going to should be constant. It shouldn't change. It's really based on the weights and dimensions. The only time I do see it change is if Amazon runs a Cubiscan and the weights and dimensions shift slightly and they might charge you a little bit differently. But those are the main costs. So if you sell into Amazon or selling it yourself, you know what your own wholesale cost is, but Amazon's going to take their commission and their FBA pick, pack, and ship. So if you look at that, that's kind of like that purchase price up at the top. You then have to worry about saying, okay, I've got to get the product inbound. I still have to spend my advertising. Are there returns that I'm going to have to pay, or this damage and liquidation? S&S discount if you're on there, promotions. Those are some of the things to think through. And then you say at the bottom, do I have to pay for these other expenses on top of this? So this is our view, my view, to say this is a way that you can start looking more apples to apples to say what's best for me. And you can do this down to the ASIN level. This doesn't have to be even at the brand level. You can look individually. So I think as we wrap this up, we can ask for any questions here, but one thing I want to note is one thing Bryce and I are offering at the end of this is if you are interested at all in walking through something like this, a 1P, 3P, P&L walkthrough. We do this with brands all the time. We're happy to sit down and try to help make sure you think about this, because maybe you're better on 1P from a profitability standpoint, and that's what you need to be doing. Maybe it's better on the third party side. But as Bryce mentioned, knowledge is power, and that's what we want to instill as confidence in you, that you're making the right decision, whether it's 1P or 3P.
Yeah, and Casey, just to touch on that, and I'll leave this up so you can get Casey's email. But what he said is true. I think a lot of times when we talk to brands, and it goes back to like, okay, you're 1P, why? When we ask them what their costs are, they'll go to maybe net ppm or a little bit below that, but they don't see all of them. And so that's what we're trying to help out with.
We've got another minute or two left. If there are any questions, burning questions, please ask those in the Q&A, and we'll see if we can answer one or two before we finish up.
Now everyone's going to go silent. As we wait for that, I hope you've enjoyed this, and I hope, as Casey mentioned, we'd love to work with all brands, but we realize that's not realistic. But we are more than happy to help analyze your business free of charge. We're not going to charge you for this piece. And it really is to try and build up this side of the opportunity where brands can feel educated and informed on what they're doing. And if you don't have an answer for your 1P why or your 3P why or hybrid why, if you don't have that answer right now, I hope that this has helped lead you to that. And as well as, in the weeks and months to follow, that you can find an answer to that and feel confident in it. That's really the point of all of this and what we're trying to drive. So we appreciate everybody attending. It doesn't look like there are any other questions. And so we'll go ahead and close it out, but please reach out if you have any questions. We're happy to help. Thanks, everybody.
Thanks all.